On June 1st, AI giant Anthropic, the maker of Claude, confidentially filed for an IPO. It became the first pure-play frontier AI company to take that step. The valuation is staggering, close to $1 trillion. And why not? Anthropic is one of the biggest beneficiaries of the AI wave. Its annualized revenue has reportedly surged fivefold since the start of the year, crossing $47 billion last month. It's of course driven largely by enterprise adoption of Claude Code and its B2B suite. But this isn't just one company story. SpaceX, OpenAI, and Anthropic together could introduce close to $3 trillion in new market value to public investors over a remarkably short window. The most, if I can use that turn of phrase, consequential IPO wave since the dot-com era. In fact, Goldman Sachs projects US IPO proceeds could hit a record $160 billion in 2026. And yet, there are questions around Anthropic's debut, particularly its valuation. Analysts say its singeing Pentagon lawsuit could reduce 2026 revenue by multiple billions of dollars. And with a projected $14 billion loss this year and $80 billion in committed cloud infrastructure costs through 2029, public markets will finally get to ask the questions that the company never had to answer its private investors. So, in this episode, I talked to Daniel Newman, CEO of data intelligence and research firm, the Futurum Group. I asked him whether Anthropic's massive valuation can survive public market scrutiny, and will the markets pop the AI bubble like it was a leveler for overvalued startups in India? Listen on. It's Friday, the 5th of June. I'm Anirban Chowdhury. This is the Morning Brief. Daniel, very warm welcome to the Morning Brief.
Thanks for having me.
Initial thoughts, how do you see this filing, the listing plans? How do you see it?
Look, it's an incredibly exciting time for markets. We've seen an unprecedented bull run for a very narrow part of the market related to AI, and the market has really not had a pure AI models foundational or frontier models company to show how much excitement and exuberance and enthusiasm there is. We know in the private markets that clearly the valuations have skyrocketed, especially for Anthropic, as it went from a few $100 billion just months ago to nearly $1 trillion in its most recent private raise. So right now the SEC is reviewing it. This gives tremendous amounts of optionality to Anthropic, because once it's been reviewed, then they will sort of have their clear to close, and then they can decide how they roll it out to the public. But we also know that the public has really only seen very limited breadcrumbs in terms of what Anthropic's business really looks like. We've heard rumors of, hey, they were profitable for this one period. And then the question was, well, they were profitable, but they also seem to have a massive compute shortage. This was causing issues, potential attrition, even with some customers moving back to OpenAI. Did that moment in time impact the company? Did they lose subs? Did they lose revenue? And as they had to sign up for more compute, whether that was the additional Colossus capacity that they accessed through SpaceX or XAI, or just the additional contracts they had to sign with hyperscalers across the board, what did that mean to their business? So I think there's going to be the confidential thing is really interesting, because I think they want to get the clear to close. They want to understand that if the SEC is going to be cooperative, collaborative, and they supportive of this IPO. But at the same time, the withholding from public is probably OpenAI doesn't see everything, the competition doesn't see everything, the public investors don't necessarily have the opportunity to fully get under the hood and scrutinize this thing. So it's a very interesting nuance, but getting there first, I'd say, was really interesting. With OpenAI obviously planning to go down the exact same path. And of course, we know that with SpaceX, OpenAI, and Anthropic now looking to go public, it's going to be a massive liquidity event for the whole market. And it's going to be really interesting where the liquidity comes from, as this narrow rally has really propelled some companies, but has also, really been humbling for a large part of the markets this year.
Okay, let's talk about two sets of numbers. A lot of it will obviously come to light? Like you said, these are just crumbs that people know about Anthropic's business, apart from the products that are visible to everyone. Anthropic's seen a surge in revenue, right? Reported numbers are 9 billion in FY25, zoomed to $47 billion. Now, the question to ask is a lot of its compute partners, say Amazon, Google, etc., are also almost like anchor investors. And there's a lot of compute credits that it gets. Do you think that the fact that this is propping up its business so much will be baked in to the valuation, to the business when the investors look at it with a keen, sharp eye after the listing?
It's actually interesting is I think it might inflate their ability to show profitability. Because on the revenue side, you could actually argue that the revenue is understated in many ways because companies aren't fully paying their bills right now. You've heard the stories about Uber and Microsoft slowing down utilization because they were seeing how fast the meter is running. So all this subsidy is going to come with a period of normalization. And so companies that want to say, we remember the term token maxing, it very quickly came and maybe it's went, but companies are trying to maximize the utilization of AI to get to ROI. But as they quickly saw that you can use AI and be very inefficient and you can spend a lot of money and get nothing of value. And with models like Opus 4.8, that can use a lot of compute, a lot of resources. And of course, as you start to build agentic workflows, things like critique or these models with agents that are basically validating and checking agents, suddenly you're using massive amounts of compute, creating very little productivity. And then the question is, who wants to pay that bill? So I do think what's happening is you've got this normalization period where companies are going to have more thoughtful, scrutinous approaches to the utilization of AI. But I also think pricing will normalize too. So the utilization will continue to go up. Jevons paradox is real, but there will be a focus on deploying AI for value. And then Anthropic has the lever of being able to continue to raise prices to less subsidy. But we're going to have a test of the inelasticity of this, right? There's going to be a test of, is there a price point where people just say, like, you see those lines, it's cheaper to hire humans. I mean, that's never going to be the long-term outcome, but the short-term outcome is going to be, we can't infinitely use these products at the true cost of compute if we're not measuring what we're doing on these platforms. And so that normalization period is going to test the overall demand a little bit, and it will have an impact as to how quickly that revenue continues to surge. Because customers right now are paying a fraction of what this stuff actually costs to use the platform, but they're starting to see what the real bills are. And then does that change user behavior at all? And I think it will. But I still think it'll create more revenue than less, because I still think people found value, extraordinary value, at the $200 a month for unlimited type of packages that were being offered in the past.
So no, but tell me, the IOUs or the unpaid bills or the late payments, shouldn't they bake into the valuation? In fact, tell me, what are the kind of margins that would justify the trillion valuation that is being thrown about?
Yeah, I think right now, first of all, it's very improbable that we're going to have positive margins for a period of time. Gross margins can be positive, but in terms of cash, the amount of compute that's going to be required and the continued spend on compute before we get to a cash flow positive net income is probably a few years into the future. Very realistically, we're not talking about being able to turn that spigot on. And it's not necessarily that they can't get to profitability too. This is a real question that all these companies are asking. If you kind of use a Mag 7 compare, Mag 7s are extremely profitable, in most cases high margin outside of Tesla, creating a ton of cash flow, but every one of them has decided to deploy all their free cash flow and plus them, meaning raising debts, bonds, equity, to actually bring in more capital to get more compute, because I realize that the value of intelligence is going to be their next margin and profitability inflection. I think Anthropic has to play the same game. So I don't think they're valuing the company at all on margin or expected profit right now. This is truly as speculative as quantum, as space. These are companies that are being purely evaluated on their ability to grow revenue with the expectation that over time they can control costs, turn levers up, continue to grow profit, and eventually bring the kind of returns that the market would expect at $1 trillion. These are some of the most exciting IPOs in history. But buying on the first day may be a bad decision for some investors. There may be a very realistic chance this thing comes out at 1.5 trillion. I mean, it could be that crazy. We saw Cerebras go up just insanely, not even on the same spectrum, and it went like double the expected IPO value. But there's also a very realistic chance, like Cerebras, that it's going to be down 30 or 40% at some period because, again, a lot of exit liquidity for a lot of investors. And, the numbers may not justify this valuation straight away. But I think over time, it's very hard not to believe that the way AI adoption revenue is scaling, that these companies can't turn the profitability corner.
Got it. But picking on your assertion that, the first day buy would probably not be wise, tell me, what would investors pay closest attention to when they're going through its, say, filing document, or after that, its business? What would be the most sharp-eyed analysis that the investors would do?
So I'd be looking at things like attrition data, like customers continuing to pay. I would be very interested in enterprise, the adoption, because enterprise has been a very big part of Anthropic's story. So are enterprises staying? Are their revenues growing each month? Any detail they can provide as to how attrition or net revenue expansion, net revenue NRR has grown as pricing is normalized. Any tea leaves you can pull from the filings about that, meaning how much pricing elasticity and power does Anthropic have? So those are the things I'd really look at. I mean, I think people will also, certainly the bubble bears are going to look at their costs. They're going to look at their contract commits. Now, Anthropic's probably look a lot better than OpenAI's because Anthropic has not been quite as aggressive in securing compute capacity. But what are those real costs and when do they come due? What types of revenue inflections are going to need to be hit to justify the valuation and to make sure that the companies are solvent, because they're going to have to, realistically, dilution. Are they going to have to raise money again? When are they going to have to raise money again? Are they going to have to raise bonds? Are they going to raise debt? Are they going to have to sell more equity? Because we all know with high growth companies that don't make money, that's tends to be part of the process. So that means your shares are going to, potentially lose value.
Right. Tell me something. Once it's listed, do you think it'll be a more difficult balance between long-term research and innovation and quarterly growth? Because the markets are ruthless.
I mean, again, it depends how the market treats the company. It's interesting to watch how companies in these sort of high growth forward, I've used quantum and space, but look at nuclear. These are markets, fusion and energy that have almost zero revenue companies that are able to continue to raise money at extraordinary valuations based on the speculation of what comes ahead. So, a company as popular as Anthropic that has as much sort of visibility day to day is going to have an enthusiasm around it that probably allows it to be treated very differently in public markets than, say, established companies that are traded on.
Got it. No, but in a nutshell, if you were to tell me two lessons that companies coming close in the heels of Anthropic can learn from its listing.
I think OpenAI has a great opportunity to look at what Anthropic's doing and react to it. If Anthropic comes out first and the market reacts negatively to the filing, they will definitely have the chance to shore up, maybe better communicate on certain areas, like how they plan to spend money, how they plan to make money. I think that, again, for other companies coming out, there really is nothing like these three. But the fact is there's always something to be learned.
Sure. Okay. Finally, my interest in this story also is that the Indian markets were a great leveler for Indian startups, which were also similarly overvalued, etc. Overall, not just Anthropic, but when others come in 2-3 years down the line, when several AI companies have listed, do you think that the AI bubble, if any, right now will be popped by the markets?
I think that there's always bubbles. So as much as I sort of am publicly known for picking on the bubble bears, I call them, the people that are always talking. Look, there's always valuations that you cannot justify. That's the sort of puts and takes of the market. That is what a good story, that is what a risk-on exuberance can create. And so you'll end up right now with certain companies in energy, in connectivity that are being pulled and having, stocks that used to not move more than a few percent, moving 30 and 40 and 50% in a day, certainly provides signs that there is a chasing of upside in the short term that means sacrificing fundamentals. So even if there's not a bubble that pops, even if the adoption of AI, unlike the internet, happens at an exponentially faster pace, there is a drawdown coming. The market does not run up. And I think not just a drawdown, but I think there's going to be a shift. We've seen this recently with SaaS. Like SaaS companies it was basically the idea that it was the apocalypse. It was the end of all enterprise software companies. They were drawing down 50, 80%. And now they've gone back up 20 or 30% because people realize it's not the end. The point is at some point liquidity rotates, meaning not every dollar goes to memory, not every dollar. So at some point, those dollars, people are going to be like, I've 10x my investment. I'm going to take some profit and I'm going to go into healthcare. I'm going to go into manufacturing. I'm going to go into utilities. That's why markets cycle. You'll see it go from an exciting bull run to a bit more of a bear market. And I think when that happens, these ones that have overrun, it'll feel like a bubble's popping for some companies. But the revenues, demand, utilization is all there. I don't think we're going to have the kind of bubble we had like with mortgages. I don't expect it to be like internet because I think the time between launch and adoption is much more compressed. And the sustained demand is much higher.
Right. Fantastic. Thank you, Daniel, so much.
It's great being with you.
Anthropic's IPO is a litmus test for the entire AI industry. It'll finally reveal what's behind the hype: inflated business fundamentals and cost piles, or robust financials and profitability. When that S1 document goes public, the numbers will finally speak for themselves. That's it for today. You were listening to this episode on The Morning Brief. It was produced by me, sound designed by Rajas Nayak. Keep listening to The Morning Brief and our other shows, including Corner Office Conversation, wherever you get your podcasts. Stay tuned.